Thank you. And without further ado, James Cromley, who is editor of Bloomberg Brief Leverage Finance, Bloomberg Professional, will introduce the first panel on chasing high yield global environment.
Good morning, everyone. Thank you very much for coming to our first high yield event in LA. As Tony said at the beginning, we are passionate about these markets, and to illustrate that, we've recently launched a new product, Leverage Finance Bloomberg Brief, part of a series. Hopefully you'll grab one on the way out and subscribe. There's a very interesting ranking of money managers and how they're performing and how they performed last year, and if you're not on that top 10 list, then maybe you should be, and we hope to see you there next year. So we have a real top quality panel here today, and we have very little time, so I'm going to get them to speak as much as possible. Please engage with them, please ask your questions, and you can email them or just shout them up to the floor. I'm going to start. We've scoured the world, and we've looked far and wide for somebody who combines the two worlds of Hollywood and junk bonds. It wasn't easy, but we've managed to find Ken Lipper. So I'm going to start by directing the first question to Ken, really to look at where are we now in terms of the market. It's come off significantly over the last few weeks. It looks like it's trending lower. Is this a technical short-term correction? Is there something more fundamental going on? Where do we go from here, Ken? What do we see in the short-term outlook for high yield?
Well, I think that the trending off is possibly based upon the wrong assumption, and that is about the potential for defaults in the high yield market. I think a lot of the potential for defaults have gone due to the refinancings that have occurred and the good economic years that we've had, where large cash flows have rebuilt a lot of the companies that were at risk. But one must note that the defaults have not been lessened in their potential in the CCC rated category. The most of the refinancings have been done in the B and BB category. Very large financings, range of Ford, CNH, multi-billion-dollar financings were received very well. But only a fraction of CCCs have even been attempted to be done in the market. So that 2011 through 2015 is going to be has to be a highly receptive market for lower grade bonds. And so what do you see from that? Well, when you look at the CDS markets, there is a very, very deep differentiation between the lower grade bonds and the premium required. So if you want to get a Hovnanian bond swap protected, you have to pay 500, 600 basis points. If you want to get an oil drilling company of similar size, it's 200 basis points. So the markets have become very industry sensitive and very quality sensitive in how they're differentiating. So where you buy your high yield bonds in this type of environment is a big factor for the future. And do I have another minute?
One, yes.
Or I can
please,
stop.
No, please.
Another very important thing that the overall market is probably not taking into consideration now is that while there's been a large refinancing program for high yield bonds very successfully done, there is a mountain of federal government debt about to erupt. Between 2012 and 2015, the federal government has to refinance $6 trillion, I'm too old to remember these T's versus the B's. But the $6 trillion of debt out of $9 trillion of overall federal debt. Taking into account the CBO estimate of the new deficits that have to be financed, that's another $3 trillion. So you're talking about virtually an unprecedented event in American history where the federal government is going to have to borrow virtually its entire existing level of federal debt in a period of 3.5 years. And at this time, depending upon outside buyers like China, like Japan, like Russia, like the Arab countries, as well as many others, including our own savers who have accumulated money. But it is a very uncertain process. And when you have things that are unprecedented and so uncertain, there should be a big premium in the market for this uncertainty. I don't believe that due to all the artificial events from QE2 and other government programs, the real cost has been priced into the bond market of future exogenous shocks at the benchmark that's setting interest rates for high-yield bonds. And that it's possible, no matter how good your high-yield bond is, that the spread will automatically widen quite suddenly if you get a shock and a government financing either can't be done or can be only done at a very high rate or has to be cut back. So my recommendation is you want to stay short, go with things that are close to call if you're going to be in this market, and not just sit there and think everything is okay because defaults are going to go down.
Great.
And I would agree that that you want to harvest cash. But on the other hand, there are select stocks that are very tempting when you put them up against high-yield bonds. For example, if you're talking about getting up 5%, 5.5% for a good high-yield bond, and you look at a company like Caterpillar Tractor or Deere, the major companies, worldwide major league companies, if you look at those companies, you'll find they're paying 3% dividends, 2% dividends, and when you look at the rate of growth of those dividends are growing at a compounded rate of about 13% a year over about a decade, which means that in just 5 years, those dividends at a place like Caterpillar are going to be double. So instead of a 3% dividend, you're going to have a 5% dividend, and Deere, you might have a 4 or 5% dividend over the next 5 years. The quality of these companies is impeccable. So the risk is much better in every way than the high yield market. And then the question is, why would you buy a 5.5% or 5% 6-year or 7 or 8 year junk bond of high quality when you can buy a company of much better quality, dramatically better quality, less risk, and you're going to match the dividends over the life of that holding, of the comparable holding, and you have a much better chance of a capital gain with a worldwide footprint that a Caterpillar or a Deere has. So I think that this is the first time in the last couple of years that an investor who has a broad palette for investing, in contrast to the person who must be a certain percentage in high yield, has to really ask himself, should I be in high yield as a class for this next investment, or should I be in these big multinational, higher dividend paying, worldwide common stocks? And I think that the analysis will make it difficult to shy away from the stock market.
Do you own those individual stocks you mentioned?
I do.